Anupriya Doval from Resurgent India. Let's dive into an early warning signals case study this week. Early warning signals have become official tools for banks to detect and mitigate financial risk before they escalate their defaults. Banks have been working towards strengthening their early warning signals or EWS monitoring systems since the RBI released guidelines on 15th of July. Let's examine the diamond industry as a case study and explore how banks can and could have stepped in before defaults surfaced. Between 2017 and 2020, the diamond industry experienced a structural downturn marked by a decline in both demand and revenue. From 2017 on, the rough diamond market experienced a continuous downturn in sales, culminating in a notable drop in 2020. During this period, near record rough diamond production combined with weak demand for polished stones cascaded through the entire supply chain. The accumulated inventory in the upstream sector steadily increased from 2017 to 2020, reaching its peak in 2020. As a consequence, most industry players incurred losses and their credit profiles weakened. Several players failed to meet their debt obligations. The bankers ought to have identified the structural vulnerabilities in the sector and taken proactive steps to address them. A few years prior to the period in question, the industry was in relatively good shape, with Indian retailers performing well. One major retailer in particular experienced rapid revenue growth. It had consistently met all its loan obligations. The retailer had borrowed a total of over 4,000 crores. In the preceding 18 months, it reported a turnover of more than 7,000 crores. The company, in a dramatic turn, defaulted on all of its loans. The retailer had used a large portion of bank limits in the form of non-fund based facilities. These helped in the flow of raw materials. The borrower also maintained high cash and bank balances. Suppliers in the markets outside India used the LCs to raise money, which quickly turned the non-fund based exposures into fund-based ones. Banks were unprepared for this. Unlike fund-based loans, non-fund exposures were not well secured. When the retailer's LCs defaulted, banks fund their loans not only in default but also lacking proper collateral. A more proactive approach from banks, including early detection of key financial red flags like excessive receivables and extended working capital cycles, could have helped the lenders get a sounder grip. Thanks for watching.